Welcome to Coffee and Keys, where we blend our expertise and personal experiences to unlock your awareness of the real estate industry.
They're the best.
Here they are.
And now, here's your hosts, Darlene Kemp and Crystal Jacques.
Wow, it seems like it's been so long since I've seen you.
Which means we could talk forever.
We could talk forever. And again, we're not going to do that.
No. We'll try to keep this one. Oh, I'm excited about this one, though.
I am too.
I'm excited because I've got a lot of questions and things like that. But at the same time, I'm a little afraid of this one, too, because, it's a different animal. What are we talking about today?
So there is a new buzzword out there in real estate. It's called assumption.
Assumptions, and they're becoming more and more popular. I'm getting questions about them every day, and then people are asking me, "Can you do an assumption?" I'm like, "It's not a new loan."
It's, you know what? So
no,
I agree with you, and I'm getting a ton of questions too. And that I, go to you and say, "Okay, fill me in on this, or what does this mean?" So that I can go back to my buyer. So there's 4 questions that I get constantly. And so we're gonna answer those questions
at least
today.
4.
Hopefully.
Try to keep this short. Yeah. I did a 2-hour training on this, right?
You did. I wasn't there.
2.5. And I went over. Yeah. Go figure.
All right.
Yeah.
So we're coming to the expert then. All right. All right. Here's the 4 questions about assumptions. In a nutshell, what is an assumption? That's the first question.
Okay.
The second question is, who can assume a mortgage? Can anybody just walk in and assume a mortgage?
Good
the
question.
Third question that I have is, why would somebody want to assume a mortgage? And of course, the fourth is the difficulty. Is it difficult to do an assumption? Is it time consuming to do an assumption? So,
based on what we are hearing, right? And that's what we're here to talk about today is how can we get them done?
I have read the nightmares. Yeah. I have read the nightmares. So we're going to clear up some of these things with this.
Hopefully.
This new buzzword that we have.
Yeah, I definitely believe in assumptions. I think they're a great thing for buyers in some situations, but not every situation, right? They have to make sense. They have to make sense. And hopefully we'll clear some of that up.
All right. So number 1, tell me in a nutshell, what is an assumption?
What is an assumption? An assumption is basically where a buyer is coming in and they're assuming they assume the responsibility of the seller's current mortgage. So they take over that remaining loan balance for the remaining number of years at the same, terms. In other words, the same interest rate, the same type of loan. They're just assuming responsibility for the seller's loan that is already in place.
All right. So you said a couple of things that, I kind of want to ask a little further into.
Okay.
You said the balance, and I think everybody knows that. I mean, I've had people, call me and say, "Hey, look, I have a friend, I want to assume his loan." And so then everybody gets stuck on the balance. But the big question is, you said the terms and the loan. So are they starting over? Are these buyers starting over? If the friend owned their house for 5 years on a 30-year loan, how much time is the buyer assuming on
whatever's
that loan?
Left. The number of months that are left.
25 years.
25 years left. If they've paid on it for 5 years, they're taking over that existing loan at that interest rate for the remaining term. So they're only getting 25 years left if they've been paying on it for 5 years. So they get the lower interest rate, they get the shorter term. They're more into, they're at a better place in that amortization schedule per se. So they're just taking over. They're assuming it there. Now, back up a second too on an assumption, right? So, in the old days, we used to be able to do assumptions where it was no qualifying and anybody could assume that loan. But then the seller would still be responsible for it, right? So there's three different ways that somebody could assume a loan. I did some slides on this one because I was going to take some short.
Oh, good. Let's see them. Do share.
Let me see if I can share a screen on this one and kind of give you a little bit of that. Let's see how this goes. With that, let me see if I can expand this one. There we go. So with an assumption, right, where they're assuming an existing mortgage that takes in place, the buyer can either purchase the property subject to, or they could assume it, or they could do it with a release of liability. So that's the biggest thing that we have right now is, you can sell your house to anybody you want to. And if you're going to sell it on an assumption, are you going to sell it subject to the loan, which simply means that the original borrower will be liable for that debt, but the new owner understands that if that term of the notes are not fulfilled, the lender can still foreclose on the property. In other words, you can assume the house, take the lien subject to, but if you don't make the payments, the lender still has the right to get foreclosed on, right? They can take the property away. So, and then in today's mortgages, you're taking over the term of that note. So if the term says that you can, the lender can foreclose on the property if you change titles or change people. If there's somebody on the note that the lender didn't approve, they can foreclose on that property. So you're taking a risk that note can be called due in full and they can foreclose on that property. So if you're assuming it's subject to, it can be done, but you might have to refinance real fast before the lender calls that note due in full, right?
Okay.
Now, the seller's in a big pickle on that one because they're 100% liable for that debt.
That note, yeah.
And if it doesn't get paid. So, or you could come into an agreement that says, I agree to assume the loan. The new borrower is agreeing to take responsibility for that debt. However, the lender hasn't agreed. So if the lender doesn't grant that liability, then technically both parties will still be responsible for it. So now that lender can come after both parties if it's not.
Wow.
Right?
So
because
let me get this right. So you could sell your house to somebody where they assume it on the second paragraph here.
Okay.
But, that previous seller goes on with life, and 20 years later, the buyer defaults. They're coming after the seller?
They are. Then they could come after the seller for that one, yes. Because the lender has not released liability from the buyer. Now, of course, they do that through foreclosure. And if you get enough money in the foreclosure to pay the debt, there wouldn't be anything left to come after. But yes, it could. And most lenders nowadays are saying, if you're going to have somebody assume the loan and agree to it, then get a release of liability because then you're protected, right?
There you go.
Because even when they agree to assume it, if the lender hasn't agreed to allow the new buyer to assume it, they can still call the note due in full and foreclose on the property, right? So the one that we're looking at is really called novation or release of liability. So that's where the new buyer applies to the existing lender. They can't call me. I do new loans. They have to call the lender that is servicing that current loan, and then the lender approves them. And once the lender approves them, then they will modify that existing mortgage or deed of trust so that the seller is now released of all liability and the buyer is the only one responsible for making the payments back on that note. Right.
So and that's a good point there too. And I think I'm pretty sure I made this mistake when I first was learning about assumptions, that buyer, the one that's going to assume the mortgage, has to stay with the lender that has the mortgage. You cannot take that and go to another lender. That's
no. You're assuming the existing loan in place, and that no matter where that original seller went to get that loan when he bought the property, that loan could have been sold to different servicing companies that are responsible for collecting the payments, paying the taxes and the insurance if you have an escrow account. And ultimately, they're also responsible for a foreclosure in the event of a default and handling all that, right? That's the servicing company. They're responsible. And they're also responsible for this piece on this assumption. So that servicing company is responsible for making sure that the new buyer credit qualifies for the existing loan in the same manner that the original borrower did. So then if that borrower fits the same spot, they can assume that. Not on every loan, just on the loans that
okay, so who can assume a mortgage? What's the right spot? Who could be the assumer?
So on a VA loan, on an FHA loan, and some USDA loans, those are the only loans that are assumable. Most conventional loans are not assumable. In other words, the lender will not allow that loan to be assumed. So, and again, with some exceptions, there are exceptions like for somebody who has heirs that inherited a house, as long as they continue to make the payments, that is an exception. Or for divorce situations, some of those things, you can not have to worry about getting approved for that assumption, right? But the new buyer must apply and credit qualify in the same manner and release the original borrower of ownership. So they the buyer has to go back to the lender. They find the house, the seller says, sure, you can assume my mortgage. Yep.
Now they have to contact the lender and qualify.
They have to contact that lender, correct, the existing servicer, and they would have to qualify. Now, in order for them to do that, too, that loan actually has to be in good standing. In other words, if that seller was in default, or if that seller did any type of modification or anything like that, in most cases, that loan needs to be brought current either before or at the closing for the assumption.
Oh my goodness! So there are some rules.
There are some rules. There definitely are some rules to that one. But so a little bit about how that assumption works there too, right? So I kind of did another slide here to kind of show this. So if you have a house that's say valued at $420, it's just an example that I've given. Let's say their existing loan on the property is $345,571. That equity portion there, right? Somebody has to pay the seller for that equity that's in the property, right?
So does that mean the buyer has to have $74,000 in this situation, $74,429?
Correct. So
that's interesting.
That's one of the things that I've heard too was, well, yeah, I'll just take over your payments, no problem. Well, it's not that simple because the seller is selling the house at $420, but the existing loan is only $345,000, right? So somebody has to come up with that equity
to pay the seller.
Correct.
So does that mean that if you don't have $74,429 in the bank and as the buyer in your bank account, that you can't buy the house? Not
necessarily.
Okay. Well, do tell more.
Okay. So, in that equity, you could, maybe find a home equity line of credit or a second mortgage that can help you with some of that. So you'd have to qualify for that as well. Or you could ask the seller to hold a note for part of that equity there too. So you could get a little bit creative on that amount. However, the seller, is going to want that equity, and you can't change the term of the existing note, right? It all has to be, that note's going to stay, that mortgage, you're assuming that existing mortgage. So right. To be able to assume somebody's loan, then they either have to come up with the equity in cash or find a way to come up with the equity for cash, whether it be a second or negotiated seller holding a note or whatever that might be. But anybody can assume a loan as long as they have the equity in the property and that they're credit worthy where the lender will approve them. So on a VA loan, anybody, they don't have to be a veteran, anybody can assume a VA loan. So
anybody that did not serve in their military, anybody that qualifies, that is not entitled normally to a VA loan, can now assume a VA loan. Is that correct?
That is correct.
Well, that's interesting.
That is, and again, it's another misconception. However, that veteran used a dollar amount of his VA benefits, of his VA entitlement, to secure that loan. Remember, I talked about the VA loans where they have to have 25% of their entitlement in order to get 100% financing to secure that mortgage, right? So there was a dollar amount of entitlement that was used. So if they allow somebody who is not military and does not have that dollar amount of entitlement, then they can't get their entitlement back. So they're not liable for that note. They can't come after them, but they also do not get that VA entitlement reinstated if somebody assumes it and they're not a veteran to substitute their VA entitlement for the seller's VA entitlement.
Oh my goodness. Okay.
So that's what we call an assumption with release of liability. And then you want to add, are you letting them assume it with substitution of entitlement? So if the seller wants their VA back, they have to sell it to another veteran who has that dollar amount of entitlement, or two veterans that could split their entitlement to that one. Right. And then that veteran also has to own or occupy the property. So to do substitution of entitlement, you have to sell it to another vet that intends to occupy the property. Otherwise, you can let anybody assume that VA loan, whether they're going to own or occupy it, whether they're going to use it as a second home, whether they're going to use it as investment property. Anybody can assume it as long as they credit qualify. In other words, they're going to look at their credit history. They're going to look at their income. They're going to look at their debts, make sure they fit the ratios. They're not looking at an appraisal. They're not looking at the property.
That was my next question.
They're not looking at any of that. Nope. They're only looking to make sure that they credit qualify.
Okay, so we have a house, and I'm glad you put up this slide. For 400, it's listed for 420,000. They only owe 345,000 for the house. Mm-hmm. How do we know that house is worth 420,000? What does the appraiser say? What numbers does the appraiser look at? So you do no appraisal.
No appraisal. No appraisal. And again, we had this discussion before. What is somebody's house really worth?
What somebody's willing to pay for it.
We've seen that in the days where people were paying $10,000 above appraised value, right? Yeah. They were guaranteeing $10,000 above appraised value in order to get that house because there was multiple bids on it, So that house is worth what somebody's willing to pay for it. Right. So that equity is really just whatever the buyer is willing to pay the seller. Then there is no appraisal. There's no anything, because that buyer may say, I'll be glad to pay you a little bit more than the house would have paid for because I'm getting such a better payment because your interest rate is so much lower. I'm saying saving $10,000 a year in interest payments because you've got a lower interest rate than what the market is now. Yeah. So for them to pay $10,000 above appraised value is nothing. They're going to make that back in 1 year.
So, you kind of look at it as, back 3-4 years ago, interest rates were at 2.25%, 2.5%.
Got some really
and so
good
then now 4 years later, this person lists their house to sell. And so the buyer wants to assume that. So when you look at the value of the house now, 4 years, in the future, the value has increased. That's where your equity comes from. But the buyer's paying a payment from 4 years ago.
Right. So what difference does that really make, right? So if I were to go out and do a new loan for a veteran on that 420,000 value, it would have to appraise for that, right? So then they're going to have, especially if it's a veteran that's never used his VA before, he's going to have that funding fee that gets added on top of that, right? So now they're actually borrowing 429,000 because their funding fee is added into that loan amount. And that's today's interest rate, let's just say 6.25. Again, it depends on credit score, it depends on all that stuff on that. So they have, that APR there. So their term of their note is now 360, right? That's 30 years. 360 payments, but their payment on that one, including principal and, taxes and insurance. So it's, kind of guessing what the taxes and insurance is, $3,076.61. Now they still need to bring money to closing, right?
Yeah.
Because even though VA has zero money down for down payment, they still have closing cost. So the approximate closing cost in this area, again, every area is a little bit different, is going to be about $16,000. So that's on a new loan. That's what somebody would be looking at today.
Because you have to pay. House. There's some things that the lender has to be paid.
Yeah, the lender has to be paid, whether it's,
but you don't have to on an assumption. It's already paid, right?
Yeah, there's no origination fees, processing fees, none of that. There's no discount points, or anything. Everything is in there. The loan is already there, so there's no lender fees. There's still title fees. You still have to pay a settlement company. You still want to do a title search. You still want to do all those things. So there are still closing costs, but just not as much. You don't want to pay the lender fees, right? So let's just, move over to the VA assumption. So now you're going to look at that same house, and the what's left on that mortgage is $345,571, right? This particular one, this particular one was at 2.25%.
Right.
So their payment, including taxes and insurance, was only $1,849.72.
Okay.
Versus $3,076.
Wow,
now,
what a big difference.
Right? Again, what do they have to bring cash to closing? They have to pay that equity. Right. So between the equity that was in that house and between the closing costs, now they need $81,184 to assume that loan. But again, if they're selling another home and getting equity from another home, they could put that equity down and assume this one, and their payment's only $1,849 versus the $3,071.
Wow.
Right?
What a great deal!
What a great loan. But again, let's kind of look at apples to apples, right? Okay, so and that veteran went out and got his new loan versus assuming this one, they'd have to come up with a cash. Well, what if he doesn't have all that cash? Again, you can. So on that third column there, let's say that you found somebody who would allow you to do a second mortgage on a purchase money, home equity line of credit, or a second mortgage. And you have to qualify for that payment when you qualify for that note, right? So in the second example is somebody who used a HELOC or a second mortgage to, and most of the time they'll only go to 90% loan to value, which means they still have to put 10% down, right? And then they still have some closing cost in there, right? But they've got that blended rate. So between the first mortgage and the payment on the second, their payment's only $2,042 versus $3,076. So they're still saving $1,000, but they do have to come up with about 10% for $47,000 between the down payment and the closing cost on that one. So they're still saving quite a bit of money in there, $1,000.
So so assuming that the person had to go out and take out a loan for the equity.
Correct.
Even though that interest rate is higher and it's today's rates, not 4 years ago.
Right.
It's
most of the time you're going to get that home equity line of credit where, again, depending on your rate, they're going to be based on prime plus 2, 3, 4, depending on what they are. Prime is 8.5 right now. So you're probably getting 10.5. So
But it's still, when you take about...
But only on the equity portion, right? Because you're still getting... I was going to say, it's a smaller loan. It's a smaller loan, even though you're paying 10, maybe 10. Yeah. But it still saves you a lot of money. Yeah. You're coming to closing with $47,000. So let's, again, take it apples to apples. So how about I go, okay, well, if I have to put 10% down, what if I got a VA loan at 10% down? Okay. So let's look at if you went out there and let's say you sold your house, you're still, even though you're going to go a VA loan because they're great interest rates, right?
Yeah.
You're going to go with a VA loan and put 10% down. You're still looking at, a 6.25% interest rate on that 90% of the loan. So with taxes and insurance, the whole ball of wax, your payment's still going to be $2,791. So it's still going to be $700 over,
what you could have done,
assuming plus the right. So you're still going to be higher. So that's what makes a difference. But that's not the only thing that makes a difference. I'll show you kind of the real difference and why it may make a difference in the market, right? If you take that same scenario, now let's look at what the buyer needs to have an income for. What do they need to qualify? right? So if I take a veteran out there that's getting 100% financing to buy this $420,000 VA loan, let's assume they have debts of about $350 a month and some compensating factors to get them a 45 ratio. Anyway, normal qualifying stuff, right?
Right.
They'd have to make about $91,000 a year to buy a new house at $420,000.
And they're going to pay more.
And yeah.
Okay.
Yeah. $3,000 a month. That's why they need to make the 91,000. So if they could assume this loan, if they could take the money out of their old house and take it and put it down on this house and assume this loan, they only need to make 58,000.
Wow.
To buy a $420,000 house. Now, again, they may not have 80,000. So let's say they have 10%. Let's say they can do the 10% down, and assume it, right? They have to count the payment for the second mortgage, right, against them in qualifying.
Right.
But now they only need 60. They don't need to make 91,000 a year. They only need to make 63,000 a year with limited debt.
Wow.
Okay?
Unbelievable.
Versus somebody who went out and got a brand new VA loan. Even if they put 10% down, they'd have to make 83,000 a year to qualify for it. So the difference really is how many people can afford to buy your $420,000 house.
That is true.
Out there. Versus how many people that are making the amount that need it traditionally, right? So it makes a difference on how much of a house you can qualify for, right? So if you really look at it apples to apples, what does it really mean? If I took that VA person who had 10% down based on that income of $65,000 a year, because if you look at this one, this middle one here with the assumption, even if they're getting a second to help pay for that equity, they needed about 63. So if you took somebody who makes $65,000 a year, again, with the minimum debts of $350 a month, most of the time they have more debt than that. Budgets, keep that in mind. That make your debts make a huge difference, right? But that person could only qualify for a VA loan with 10% down of 309 versus 420, right? So let's say they're not a veteran and they have to go FHA. Well, now they only qualify for about 292, right? And if they went conventional, they only qualify for 290, right?
Wow.
So it makes a difference on how much of a house that somebody can qualify for. So that's really what makes the assumptions attractive, is because now that person can buy a home that they wouldn't be able to qualify for at the higher interest rates.
So I think you answered the third question. Why would somebody want to assume a mortgage?
Right.
And so who wouldn't want to assume a mortgage?
Who wouldn't want to assume a mortgage? You're going to get a lower interest rate, lower payments. Absolutely. Why would you not? Is really because of the interest rates. And historically, over the last 10 years, we've been lower than average interest rates. I mean, again, telling my age here, but when I got in this business, interest rates were 13%. And people were happy that they were 13 because they just dropped from 16 and 18%.
Right.
And at that time we had no qualifying assumptions, and that was a crazy world. But yeah, so that's the main reason they'd want to do an assumption, is because they're going to be able to get more house for their money.
So how do you find out what assumptions are out there? I mean, is there a list? Because I get that question. That's why I asked. That's what I asked. How do we know what's out there? And it's just a simple question. First of all, some listings do say in the agent remarks, this loan is assumable, and they actually give the numbers. They give, the seller still owes blah, 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 blah on the house. We're at an interest rate of such and such. You can make your decision there. And certainly when I see that in a listing, I bring it up to my buyer. At that point, this one's assumable. And then I have this question, this conversation, not as in depth as this conversation is, but that's when I'm handing them to you, because you need to go talk to the expert if you're interested in assuming it.
The hardest part about the assumption is there really is nobody to call.
That is true. That is true.
I do new loans and do mortgages. So the reason I think we're not seeing a heck of a lot more assumptions than we're seeing right now is because there's no guarantee to the seller that this will close or when it will close.
That's number 4, Darlene. Yeah. How difficult is it, and how long is the process? Now, I'm going to put it out there that I have read about the painful journey of an assumption. I've read that time and time again. So you tell me what you know.
So what the issue on most assumptions is the buyer can't get pre-qualified until after they have a ratified contract. Now, is that not a little late to know whether or not you can qualify
because why are they out there? How do you know that they could even afford to buy a house?
Yeah, so you've got a seller that now is risking accepting a contract from somebody to assume their loan because they don't get a pre-qualification letter. They can't call a loan officer and say, hey, have you gotten all their documentation? Because the servicing company is not going to qualify a borrower until they have a ratified contract. They're not going to start the assumption process until they have a ratified contract. So if you were an agent that's working with a borrower that wants to assume a loan, hopefully you have a really good relationship with a lender that you can say, hey, look, can you do me a favor? They want to go buy an assumption, but would you at least
knowing that they're not going to use that lender?
They may not. Now again, I'm going to give them a side-by-side picture, just like I said. So hopefully the lender will say, here's a new loan. Here's a loan that, so here's your options in the real world on today's financing. And here's what you're going to need to do the assumption so that, hopefully they'll be talking to somebody that can give them what the true options are. And I've always said, if it makes better sense to do the assumption, I'll be more than glad to help you. But if you find a house that they won't facilitate or the seller won't let you do the assumption, here's what it's going to be. So typically when the borrower calls me to get pre-qualified, right? The typical route is I'm going to qualify them based on today's interest rates, right?
Right.
So I'm going to give them a sales price that they should be looking at based on today's interest rates.
Right.
But what I'm really qualifying them on is a payment.
Right. Well, most people want to know that. What's my payment going to be?
Right. But a lot of times the agent wants to know, well, what price range should I be showing them? What do they qualify for? Right. Mm-hmm. So what the conversation as a buyer's agent who is representing somebody that wants to go do an assumption is, hey, look, we may not find an assumption. So I want you to tell me what sales price they qualify for in today's market price. Right. And then what's the payment of that? So now you can get them pre-qualified. I'll do like I normally do with any loan. Cause again, what are the chances of them getting a contract? That's an assumable. So, but I'm going to give you two numbers. This is the sales price that I can get them based on today's market. And this is the payment that they're qualified for.
Right.
And that's where you need to take the ball and run with it because you're saying, okay, you are approved for a payment of this.
Right.
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 So now you can, now you can go show them houses based on whatever that payment that they're qualified for and the loan program they're qualified for. So if you find an assumption, you're looking for a payment on that assumable loan that's within the qualification.
So it doesn't make sense because my mind is kind of spinning backwards here.
Yeah.
When you have somebody that's been in the house 15, 20 years on a 30-year mortgage, right? And they have equity of $250,000 in this house. They've been in it a long time. Does it make sense to approach an assumption at that point? It could.
Again, and now I just stopped sharing. That was the screen there too, because really it's just about negotiating and it's understanding what, what that seller is looking for. So, if he's got equity in the property, he probably wants his cash equity, right? So that I can put it down and use on another house. But what if he's retiring? What if he's, going in, downsizing? What if he doesn't, want all that? What if he needs income and not what it's a, divorce situation and now she just needs an income to help subsidize her living. Well, they could agree to do a second mortgage, right? They could agree to negotiate that. So
and still be the interest rate could be less than the market interest rate.
It could be, because again, it's negotiable, so you got to look at the terms. But let's say somebody's gonna finance $40,000 at 10%, which is probably what they'd get on that second if they had to go out and get a separate. Then they could make $4,000 a year. I get an extra $20,000 in 5 years in interest. Yeah. So they could make an income off that. So the key is just to really kind of understand, number one, what is the seller's goal out of it? You know, if he accepts an assumption, he might make $10,000 or $20,000 more. He might make $4,000 a year for the next 30 years or whatever that interest is he wants to charge on that note, right? So it's just about putting all the pieces together. And that's where it really is going to take some expertise in the real estate agent that you're dealing with and having a conversation on
to understand
what is the seller willing to do? What is your buyer willing to do? How can we put all this together? So it's, you know, it's not an easy conversation to have, but I'm not saying they should not go look at it. Right. But the risk for the seller is that, there's so much unknown without them actually talking to a loan officer to find out what the buyer does qualify for.
Right.
And without asking the questions of how much cash, you know, how much equity do you have? What's your remaining loan balance? What's the equity? How much cash do I need to assume it? Right. And then asking the seller, are you willing to make some money off the interest on the note? I mean, think about it. Lenders lend money to make interest, right? So why not? Who's to say your seller doesn't want to do the same thing? He can lend his equity and make some money off of it, right? That's what we did a lot with financing way back when we had the assumptions popular 30 years ago, right? So we kind of negotiated because there was normally equity in there, and the seller was willing to let them assume their existing note and then take back a second. So, you know, the big first thing you want to know is what payment do they qualify for? Because if you do the assumption, you want to know that the lender will be able to qualify them and release the existing borrower of liability. Right.
So
I would think get foreclosed on.
I was going to say, I would think as a seller, I would want to be released, you know?
Right. And so you want to make sure they're qualified before you accept that offer. So you can, you know, talk to a relationship lender, mortgage company that you know, and get that person pre-qualified or pre-approved for not just a sales price or a loan amount, but for a payment so that you know what to look for them, right? And then once you negotiate that contract, you know, then things are done a little bit differently. And this is where the seller really doesn't know when it's going to close, because in the real world, what I'm going to do is I'm going to qualify somebody and I'm going to qualify them, and I'm going to start gathering all their documentations to prove that what their income is and what their assets are, right? And I'm going to start that process, and then I'm going to give you a pre-approval letter and say that part's done. Now go find the house, right? Here's the sales price. Go find a house, negotiate the contract, and then when you come back, I'm ready to kind of move forward, right? You've given me a ratified contract. Yeah, you got to schedule the home inspection. Then we do an appraisal. The appraisals normally take 10 business days or 2 weeks on an average, right? And then normally order the title and stuff, and then I can close a week after that. So normally I can get it done in 30 days, no problem. Except but on an assumption, every servicer has a different procedure that they're dealing with your borrower that has to go through them to qualify.
So that's what drags it out. That's what can drag it out.
They have no real loan officer there to like say, hey, I need that bank statement. Hey, I need that pay stub. Hey, you need to get me this. Hey, no, the first thing you do is you call up and you call your the purchaser. I mean, not the purchaser. The seller is the one that has to make the first contact because it's his loan, and that's the only person that they're going to talk to, unless you get a third-party authorization form allowing you to do it as an agent. But most of the time, that seller is going to have to call, and the person that they're picking up the phone, that's a servicer, may not even know what an assumption is. I've had the case where I actually called the servicer, and they said, "This loan's not assumable." I'm going, "Yes, it is. It's a VA loan. They're all assumable."
Yeah.
Can you let me?
I think when you sign your loan documents, when you purchase the house,
that's the advantage of it.
It talks about assumptions in the documents.
It absolutely does. You have an assumption rider on your deed of trust that said this loan is assumable, so the lender cannot deny you the chance to allow your loan to be assumed.
Right.
They just have to qualify the borrower in the same manner that you did. So your loan is assumable if it's a VA or an FHA loan, and your servicer must help you facilitate that.
So who's doing all this legwork? You know,
that's the problem.
I was going to say
you are
as the agent,
and the agents. And again, you know, we're trained.
I'm not
in mortgages.
A lender.
I know. But there's no more, So here's the best way to kind of facilitate that as an agent, as a buyer and a seller, is you have to get third-party authorization that would allow you to call the servicer to figure out where you're at. So the seller
third-party authorization is
third-party authorization.
It's a form.
that the lender, the servicer, will send you that says, here's the people we're allowed to discuss your loan with.
Okay.
Right.
So what,
that
the buyer
person
would
could act as my
sign
behalf.
it?
So the buyer would sign it and the seller would sign it, because the seller has to sign it, allowing the borrower to get access to their loan information so that the borrower can fill out the assumption package. But I'd also have them allow the agent, as the representative, to be able to call and get information based on that loan as well, so that you can help them follow up on it and make sure what steps that it's in. So the first step is to get the assumption package. And the first step is to have the seller call up and say, what is your process? Will you give me an assumption package now that I have it listed? And some servicers will not.
They
Some
will not
servicers
release it?
No.
Isn't that the
we
right
need to know
of the
that
seller?
You have, it, yes.
Okay.
It should be. And again, that's when I would say, can I talk to a manager? I'm just trying to find out what this process is and then what needs to happen for somebody to assume my loan. So the first thing that has to happen in order to get this thing to flow smoothly is for you to be able to call up and say, what's your process? When can I get an assumption package? What does my buyer that bought my house need to do next? Sometimes they have to call and talk to somebody, give them all their information. Then they'll send them out a package that's not really even a loan package yet.
Yeah.
It's just a package saying, I need all this information, and then get a copy of the contract to prove that we're not wasting our time, that there is somebody on the hook that's going to assume this loan, right?
So they have no idea if they're qualified. These buyers don't know if they're qualified at this point.
Not unless they've already talked to another lender about getting a new loan and what they would qualify for. They do not. So that by the time they get the assumption package, that's only to get them in front of somebody that would be able to tell them what is needed to figure out if they qualify, right?
Right.
Now, VA and FHA have some strict guidelines to servicers that say the minute you have a full loan application, you must render a decision on approval within 30 to 45 days.
Oh, okay.
Depending on how they do it.
So it
should be done in 30 to 45. However,
there's a light.
It says once they have a full loan application, which includes all documentation. It could take you 3 weeks to get to that point.
The light just dimmed.
Right? Because somebody has to make sure that a full loan application with all documentation is turned in right up front. And it could take you 2 weeks just to be able to get the loan package for the borrower to fill out and turn in. Because you have to get the assumption package, then you send that in, and then they'll call you to have you schedule an appointment with somebody that might be considered a loan officer that will take that loan application for you. And then they have to disclose, because again, you've got the Respatilla laws that say you have to disclose within 3 days of taking a full loan application.
You have to disclose the numbers. That is the numbers.
You have to disclose the numbers that the cost of it's going to take, and the closing cost that's going to be in there. So they have to send that out, right? There is no appraisal, so you would think it would be done a lot faster. Because you don't have that, 10 working business days or 2 weeks for that appraisal, but it's going to take an additional 2 weeks up front. And then the other problem is the minute that the borrower sends in what they think is a loan application, does the servicer believe that it's a full loan application? Do they think they have everything that they need?
So they come back and ask for different things, supporting documents.
Yeah. And as a loan officer, I will tell you, half of my time is calling people up and say, hey, I need that pay stub. I need that pay stub. Hey, I need, we see this thing letter here on your pay stub. I need to verify your employment is going to continue. I need all the pieces to the puzzle, right?
All the way up until the end.
All the way up until the end. Correct. So that's the struggle on these assumptions, is that the servicers don't have that loan officer in place per se at the beginning. So you're
dealing with people that don't understand.
You're dealing with people that really so it could be 2 or 3 weeks before you get an actual loan officer to review it. And then they have 30 days from that point till they get a full loan application. So you're looking at
basically 45 to 60 days or more.
And some lenders will say this could take you 90 days.
And I've heard that. I've heard that. I've heard 4 months.
Now, and again, at what point do they consider a full loan application? Because VA and FHA have came up with strict rules that said these servicers must render a decision within 30 to 45 days from having a full loan application. But what constitutes a full loan application? right? Do they have all the documents? Do they have all the information? You need all that in to be able to render that decision. So these servicing departments are just now starting to get to the point where, I mean, think about it. How many assumable loans were they doing when interest rates were 2.5%? How many people were going to assume somebody's 6% interest rate? Because that's what the average interest rate was prior to, you know, the last crash and the, you know, coming in and subsidizing mortgage bond payments and things. So the average interest rate, if you look back from here to 30 years since I've been in business, if you average it out, the average interest rate was 6%. So when the market dropped to 2, 3, 4, even 5%, who was going to assume those loans? So these servicing companies over the last 10 years do not have any systems and processes.
It's all new for them too.
To be able to, it's new for them. So they're having to figure this out, right? So here you are in the beginning of all these assumptions becoming real popular, and their servicing companies are not set up or managed to handle the assumptions right now. So
it truly is a buzzword.
It is a buzzword.
Truly is a buzzword.
And I'm hearing more and more about it because who wouldn't want to take over 2.5% interest rate?
Oh my gosh!
In fact, we could probably stop sharing this one too. You know, who wouldn't want to assume one, right? It's right. It's great, but there's so much unknown about when can you close? Does this buyer qualify? What's going to happen here? Is this going to happen? Right?
So if the buyer qualifies, it'll happen. But how long? Yeah. Those 4 questions that we get, they lead to thousands of questions probably at this point.
Yes.
Well, it's great. It's great that thank you for putting it in perspective, because I get that call all the time.
What is an assumption?
What is an assumption? And so that I don't have 45 minutes to talk about that, you know.
So send them to the podcast for a little bit, right?
Send them to the podcast.
Yeah. And again, I've done training on them, 2.5 hours. So if there's anybody who really wants a training, just, text me your information. I'll put you on my next one I do. But
oh my God. Now, do you do it via Zoom, or do we have to go sit in a class?
Normally, I usually just train my agents on a lunch and learn on what an assumption is. I have a PowerPoint presentation. I can send that out. But yes, I will think about doing one as a Zoom class or something. That would be.
I would attend, Darlene.
And it's great knowledge. It's great knowledge. And I think as the industry starts to work on these a little bit more, they're going to become more popular. They're going to be able to facilitate them a lot more. But again, it's all about communication. It's all about understanding the process. And the more you understand it, the more you can help your buyers and your sellers through the process. But what I hear now is, agents telling the sellers, oh, you don't want to do them because they're just a nightmare.
Because they're too long.
Right, yeah. So why would you want to do that? Just, there's plenty of buyers out there. They're still getting multiple offers. We're still getting you what you want. Yeah. But a seller might be in a position where he thinks having his equity finance and getting some income might be a benefit. Or he may think that, I might get $10,000 or $20,000 more for my house doing an assumption than I would on a normal loan. So the key is just education. Understanding the pros and the cons.
And I have to admit, I have said that to a seller because they've come to me. Somebody can just assume it. And I'm like, look, we need to put your house on the market. You need to be in your next state.
Yeah, you've got to buy another house.
Yeah, you don't when this is going to close. Yes, I have said that.
But again, it's about giving them the options and understanding and being able to explain the options to them and the pros and cons. Mm-hmm. But to somebody, it may be worth an extra $10,000 or $20,000 in their pocket
if they're not in a hurry.
Allow their house to be, if they're not in a hurry, if they got plenty of time, and so again, it's just, when you put your house in the market, everything's negotiable, right? So it's just about making them the right offer that would say, hey, okay, maybe I will do that.
So, it sounds like an awesome option for buyers and sellers, really. Again, we as agents, sometimes we're listing a house and we're thinking we're listing at the top of the market. Sometimes the appraiser comes back and says, you're too far on the top of the market, so then we're coming down based on that third party, the appraiser, his opinion. So this is something that you don't have to.
Right. Yeah, because a new loan, we're only going to lend on the lesser of the sales price or appraised value. So then it would be back to negotiating when appraisal comes in low, and the buyer would have to agree to pay more than the appraised value, or the seller would have to agree to come down in his price, or you've got a voided contract.
That's right.
Would avoid
so
that.
That avoids a lot of guesswork on our part.
Yeah.
Well,
yay.
We're at the end. Can you believe it?
I know. Okay. Now we'll have to think of our next topic. But yeah, definitely. I think if anything else, we just spurred up a lot of more questions. But
they should be reaching out to you or me.
Or you.
And I'm going to tell them to reach out to you.
And again, as a lender, I do new loans. I don't do assumptions.
Right.
But I think they're important in the industry. I can help answer questions, but I don't personally do assumptions because I do new loans.
But you've got the answers that can guide us.
I try.
All right, Darlene.
Awesome.
Until the next week or the next
the
next podcast.
Coffee and Keys is brought to you by Darlene Kemp, VP, Senior Loan Officer, NMLS ID 173897. Atlantic Coast Mortgage, LLC is an equal housing lender. NMLS ID 643114. www.nmlsconsumeraccess.org. And Crystal Jacques, Realtor for both RE/MAX Allegiance, 4000 Virginia Beach Boulevard, Suite 164, Virginia Beach, Virginia 23452. Office phone 757-490-7300. And RE/MAX Professionals, 20,241 North 67th Avenue, Suite A1 Glendale, Arizona, 85308. Office phone 623-362-3000. Each office is independently owned and operated and supports the Fair Housing Act and Equal Opportunity Housing.